LinkedIn. Thank you very much for checking in again. Following the success of the RDLC's lockdown interviews, we were minded to do this again. And what we wanted to do is continue with our Zoom sessions with really inspiring, interesting people who can add value to the recruitment business leader marketplace. This new series is all about M&A and maximising shareholder value, something that every recruitment business leader does. Typically, the first thing you do is give your business a name, and the second thing you do is think of your exit strategy.
I'm delighted. Marcus Archer is a mate of the RDLC. He's lunched with my gang individually. He gives us loads of advice. Dean thinks he's the Don, so that gives you a great sentiment. As opposed to giving me War and Peace about his history, he's given me one line. So that reeks of confidence. So let me introduce my mate, Marcus Archer. The leading, I'm going to say the leading M&A advisor in the mid-market, a long track record of advising founders, management teams on transactions in the human capital sector. Without further ado, can I introduce my mate, Marcus Archer?
Thanks, Gary.
It's just still so laid back. It's brilliant.
So Paul is the CEO of BLUEBOX Corporate Finance. BLUEBOX's key offerings is preparing business in advance of a sale, selling businesses and raising money. Paul is recognised as an authority, if not the authority, in the sale of private companies and a significant amount of hands-on experience in selling private businesses ranging from 2 to 200 million. Your list of sales is brilliant, by the way. In 2020, Paul set up a brand new business, but I'll let you explain that yourself. So without further ado, hi, Paul.
Hey, Gary, how are you doing?
So Carl is a partner and the head of corporate finance at national advisory firm RG. What does RG stand for?
Rycroft Glenton, Gary.
Why didn't I know that?
Believe me, some things in life you don't need to know, and that's on the list of things.
Okay, yeah. Otherwise, it would have been down there before. We specialise in providing advice to businesses in the human capital sector and all aspects of growth, change, transformation, including advisory on company acquisitions and disposals. Now, Carl is a leading M&A advisor and one of the nice guys to the sector, which includes the subsectors of recruitment, search, training skills, and has advised on dozens of, and I know quite a few of them, mid-market transactions over the last 10 years. Hello, Carl.
Gary, good afternoon to you. What an incredible introduction. Obviously, the humanitarian disaster that is COVID has been concerning and something we've been looking at for a long while. And I'm not going to say we called it quite early, but I remember saying to some people in our office in January, this could happen, and everyone thinking I was absolutely bonkers. And I thought I was bonkers as well. And it's mind-blowing to see what's happened. But the very sad thing is, notwithstanding the humanitarian impact, I think the economic tsunami that is starting and will continue is going to be devastating. So what have I been doing? Well, yeah, I was fortunate. We did manage to get out to Spain a couple of weeks back, and just spending some enjoyable family time, but still doing quite a bit of work out here. But I suppose M&A, and there's not many in the market saying it, but I'll say it as it is. M&A is not booming at the moment. There's elements of M&A that are booming and some sectors are booming, but ordinarily you'd have to think, if you're thinking with your gut, that now is not the time to start running out and selling a business. I mean, there will be inevitably people who are very sadly forced into a position of an exit. And there will be, I suspect, an even larger number that have been through this and have reprioritised in life and thinking about what they're doing. But the good old world of M&A, I think, is at the moment going to be relatively quiet. I mean, don't get me wrong, I still see a flow of deals regularly. I see deals every day, and we're still involved in a number of pretty big deals, including a couple of high-profile ones, which sadly I can't talk about yet. But I think priorities will be changing. The market will be shaping up differently. As ever in these markets, what happens is the bigger advisors come down into the pond where mere mortals like us start fishing. I think that there will be a disruption, and it'll be one of those. It's a very cyclical market, and you'll know, as one of the doyens in the recruitment market, Gary, you'll know as well as I do that certain sectors are very cyclical. And I'd argue in some ways that recruitment and M&A follow similar pathways. The first to get hit, and let's all hope the first to come back. And that's where it is. And I think just generally across the economy now, there are businesses that are going to be absolutely devastated, and it's going to unravel, and we'll see that in the coming weeks and months. But as long as you've got the resources to see yourselves through, I think it's become, and I don't obviously have a conflict suggesting this, but I think there is an argument that in this market, finding a safe harbour, maybe with a strategic partner that can assist you in growing and support the business with deeper pockets, is no bad thing. So personally, not too traumatic a lockdown, and I believe we're very privileged in that regard. But economically, I think there's a lot worse to come, and the market will change, and people are going to need to change the way they operate. I mean, look at the way that we're operating now. Normally, we'll be getting together for a glass of wine and one of your fabulous RDLC lunches, and those now are unfortunately off the agenda for a while.
It's been interesting. We've all had to adapt to doing things in different ways, and thank goodness for technology. I think if this had happened in the global financial crisis, we wouldn't know what to do. But actually, with Zoom Teams, all of those different tools, communicating with people, and has actually been quite efficient. Interestingly, I've found I'm getting through more in my day, more meetings, more calls, covering more ground by doing it this way than traveling around London or around the country meeting people face to face. And building on existing relationships is works really well on this platform. Building new relationships is harder because you can't read the room and the body language, but actually adapting to ways of work has been great. And I've got loads more family time as well, which has been really nice, because in the old days pre-COVID, it was probably less time at home than it should have been. So it's been quite nice to have more family time through this period as well. 3 to 4 days a week in the office and 1 to 2 days a week working at home. It's probably a long-term balance of how we're going to work in the future.
First of all, the last 4 months have been odd, I guess is probably the right answer. We've all had to work in a very unusual way, working remotely, not alongside our colleagues and our peers, which definitely, presents lots of challenges. And of course, the economy has been hugely disrupted by COVID. So we've all had our resilience and our work ethic tested to the maximum. But for sure, there are always winners and losers. And today I'm going to try and focus in on, those whom have fared better than others, and what we can all do to make sure that we are well placed to bounce back post-COVID. But sure, the last 4 months, Gary, have been really challenging, but there have been a number of opportunities come to the fore, which is definitely what I want to focus in on during this session, Gary.
Well, shall I just let you do that? That sounds perfect. But what would you like to talk about first?
Well, I think, Gary, you asked me the question, what is the M&A landscape like within the staffing sector? So let me try and give some context first. So, to give some statistics as a start of a 10. So in the first half of 2020, so the 6 months to June, M&A activity within the sector is down 37% versus the same half last year. So of course, that simply means there has been significantly fewer transactions completed in the 6 months to June. I suspect a large proportion of that reduction in deal volume is a direct result of COVID, bearing in mind, actually, in Q1, there was a real activity when it comes to M&A, largely driven by the strong economy. And I think a lot of businesses, Gary, were performing brilliantly well, up until March. And also, of course, the changes that were being introduced in March in relation to CGT and entrepreneurs relief. So there was a huge focus to try and get deals done pre-mid-March. And thank God, we had that incentive, because following, lockdown, M&A activity has definitely been significantly more subdued.
I think it's a mixture. So I think the same old list of trade buyers are still there, but their M&A strategies are still evolving, and they're not really clear what they want to do next, and when they will be able to go on an M&A trail again. There are a few private equity-backed businesses around the world that are looking to actively grow. There's a couple in France, and it's got to happen at some point. But the American private equity-backed recruiters have got to start coming over here, and there's a couple of those around. The Japanese are still feeling quite strong, so they're still out there. Private equity for the right businesses in the right markets is definitely still out there, and they can be supported by debt. But there's probably still a good chunk of the recruitment world that's not attractive to investment for the time being, just given the dynamics and some of the pain that people are suffering at the moment.
As ever, there are different acquirers in the market, and you mentioned some of the deals that I've done, and I won't mention the specifics. I don't want to get myself into hot water, but there are buyers out there that clearly are bottom fishers, and they're waiting for an opportunity. They're waiting to pounce on deals that are in trouble, and it's not about a strategic value. It's about capitalising on a situation and frankly taking advantage of someone else's weakness. However, I absolutely believe that this is also a time where those that are best placed to create value, notwithstanding the impact that COVID will inevitably have had on businesses across the market, they will be looking for different angles. And without being too crude, if you look at someone who's at the moment in the recruitment and they're involved in meeting software, and it's a very different space to other generalists. And there may be things that people are thinking about strategically where they want to move. The one big dynamic we have seen, Gary, is private equity has, without continued to roll. And when I say that, the funds that are out there are still investing money. It's turkeys voting for Christmas if they start handing money back to investors. And they're sat there saying, we're still here and we're still out there and we're still buying. And that's providing some liquidity and some activity in the market for sure. But the other thing that's been surprising is there are strategics out there that are buying and that are looking at the right positioned, the well-positioned assets in the context of what the new world will bring. I'd be happy with any of your members. I'm more than happy to support any of your members, and it's about looking at the specifics of a business. But in some ways, you can't necessarily put lipstick on a pig, as they say. And some businesses that have been hit badly will be at this point in time unsaleable, apart from to those bottom fishers, and others will be very, very well strategically placed. It is a good time to go and acquire if you can find a strategic asset that fits well within your portfolio. And obviously you've got a realistic vendor expectation. So the market, I have to say, and I'm a glass half empty person, but the market has certainly held up better than I would have predicted back in the beginning of March.
Without doubt, there's never been more liquidity. So as you say, there'll be some acquirers, be it large, be it listed, be it private equity backed, who definitely will look to acquire distressed businesses. I think the other two areas that I would definitely say we've seen a significant uptick in activity is large international groups disposing of non-core subsidiaries. So there'll definitely be a number of opportunities for management teams to acquire the businesses they run from their founder, owner, manager, shareholders. So management buyouts are really interesting because there's liquidity in the market, so they can be funded. And of course, the management team, arguably, of any business is a potential acquirer because they know the business that's arguably looking to be sold. I think the only other third area is private equity, Gary. As you absolutely know, PE have a number of interests within the human capital sector, but specifically focusing in on recruitment. So there's lots of private equity backed businesses who will look to utilize some of its liquidity to acquire good businesses.
Very little distress or special situations. I think our view and the view of the insolvency practitioners around town would be, that particular theme of deal activity will come later in the year and next year. So as furlough unwinds or people have to pay their tax or pay their rent, unfortunately businesses are going to feel a bit more pain later in the year and next. So that's not really coming yet. Most of the clients that we've got will be in, I'll use the phrase COVID resilient because it's a bit of a buzz phrase, but that means businesses that have traded at least flat through COVID. And they tend to be in pharma, life sciences, healthcare, tech-enabled businesses, virtual training businesses, workplace compliance, health and safety. All of those are quite cool areas. So for those businesses that want to go through an M&A transaction, either with a strategic trade buyer or private equity, there's a real scarcity of high-quality businesses like that. So there's a bit of a bun fight going on for them. The other dynamic is smaller businesses that feel strong and feel like they can now consolidate. So there's a lot of activity in people raising growth equity. And they're typically businesses making £1 to £5 million worth of EBITDA that wouldn't have previously thought about M&A, that were probably thinking about selling in a year. And they're actually thinking now, actually, I've done quite well through this. Now, if I've got some deeper pockets and a bit of cash, I could go and make some M&A opportunities happen for me and become a much bigger, more exciting business and just push my exit plan out by a couple of years. And there's a lot of private equity money looking at those type of opportunities as well. The cash that's floating around, I would say, is predominantly sitting within private equity hands or debt fund hands. The private capital is typically looking for cheap and distressed opportunities. And I'd say a lot of the corporates are largely inward focused, still sorting out their core activities and probably sorting out a bit of rubbish in the portfolio. So they're not really in town in the way they were pre-COVID. So it's largely private equity funds in the mid-market that are looking for high quality businesses. In recruitment world, that means niche and specialist. It means a high quality brand with a good reputation. It means operating in an attractive market. And again, healthcare, life sciences, technology, renewables, infrastructure, those areas are the hotter ones and struggling less through this period. Long-term relationships with clients, well-spread client base, well-invested, scalable platform. Very, very importantly, a very good and proven management team that can show they've got a track record delivering growth. And right now, you've just tested your downside case for the last 3 or 4 months. So going into a business plan period where you've just worked through what you've just worked through, is a pretty powerful place to be. And those that are embracing technology and using technology and disrupting with technology will be the ones that get a gold scar and be most attractive to those funds to invest in, I would say.
Good business has to have scalable traits. Because, of course, any acquirer is buying a business to grow the business further. So it needs to be a business that has good systems, processes, procedures. It has to be a business that has a really experienced, proven, resilient senior management team who run the business. And, of course, resilience will have been tested positively or otherwise over the last 4 months. I think a good business, Gary, from an acquirer's perspective, has to be able to demonstrate that it isn't reliant on either a small handful of consultants. So we want to try and see at least 120k of GP per head coming from each of the consultants across the business. We don't want a lot of performance coming from only a small number of the billing headcount. Client reliance. We don't want to see a business that's got half of its NFI or gross profit, coming from one client. Wouldn't it be brilliant if there were, 100 clients all generating 1% of a business's GP? If one of those clients are lost, it's disappointing, but for sure doesn't compromise the business. I think the other area absolutely is the predictability around the fee income. So a business that has more recurring gross profit will naturally be more valuable to an acquirer than a business that does not. So there's probably 3 areas that I would pass comment on, albeit there's many more, but the key 3 areas that we think are differentiating a very successful, highly performing business versus one that is performing less so positively. First of all, has to be geography. If, for instance, it's a generalist IT recruitment business focusing in on the UK, that business will not be performing as well as an IT recruitment business that maybe has a significant proportion of its business sitting in Germany. I think secondly, Gary, I guess it's going to definitely be the sectors, and I mean the end industry sectors in which the end hiring clients sit. So again, let's just use an extreme example to prove the point. If your client base is predominantly businesses within the hospitality sector, the last 4 months have been horrid, full stop. Whereas if your end client is e-commerce, your business has only gone through the roof. And the third area, Gary, definitely that's having a huge impact will be, I'm going to call it delivery model. So, is it a contingent perm recruitment business? Because a contingent perm recruitment business in, let's call it hospitality, fashion, other areas will have not performed anywhere near as well as maybe a business that's placing IT skills through statement of work, and an RPO or master vend business. So I think the delivery model part is so important?
There's a really interesting shift in dynamic that's going on in recruitment. The recruitment is dead as a word, and everyone's shifting to become consultancy driven, getting paid for your effort, not just your returns, outsourced in-house statement of works, and everyone is just running into that solution-based selling at least a million miles an hour. Do you think that might change the dynamic of who might be interested in businesses? So if people can shift pretty quickly, they've got a decent cash position, they start to trade in that marketplace, can we turn an ugly pig into a beautiful business, a frog for a prince?
Interestingly, and this is not a soapbox for us to talk about our new business velocity, but actually, if you look at most businesses with the right level of strategic thinking and insight and experience in the market, I absolutely think that can be done. Going back to using old metrics and the old KPIs and the margins and the way that you recruit and the way that you engage with clients and the various models that exist out there, I personally believe that people will need to be creative. There will be clients who are clearly looking for very much value for money from a recruiter. And there will be models. It's one of those things, I mean, it drives me absolutely bonkers every time we go out and recruit people, the fees that we pay to your lot. But it's a necessary service and there's no way around it. And people will need that. I think the supply side in many businesses is changing dramatically. And when I say that, I'm saying, if you take M&A, I've just described how I described at the outset how the clients are changing and how the volumes in our market are falling, and maybe we'll come on to what people are looking for differently. But the other thing people need to realise is that the supply side of our business, which is frankly people and very good people, is going to change. The way that we engage with them, the way we find them, and the way that works. So I believe that now is a great time with people with energy and vision, if they can create and set about a new model that doesn't simply follow, oh, do you know what, we're going to look at a contract margin, and we were 16%, we're post-COVID now, we're at 14%. It's the wrong way to be thinking. This is going to be entirely new models, entirely new ways of engagement, a way to differentiate yourself in the market, the way to create a barrier to entry. So you can, I think, do that. And it's interesting you say with the cash that these people have, it's a great place to be. And if they're well funded and they've got some great ideas, then absolutely, I think they're going to be well placed to grow, because recruitment as a service is something, because we all know, and all of, many of your friends and colleagues know, is an absolute requirement in the business world.
Well, the number one thing I think for any shareholder who's heavily involved in their business is to think about that transition to the next generation. So making sure you've got the right senior team in place. If your objective as an owner, manager, founder, entrepreneur is to make some money and get some liquidity and leave the business ultimately, then you need to make sure you've got a proper team in place. And that transition from owner, manager, who's got all the magic dust of their own DNA over a business, stepping away and handing the reins to the next team, it's a big step and not to be underestimated. So that's always the first thing that I would say. I think that investment in technology piece will become more and more prevalent. So having a strategy around technology is definitely an important part of that. I would say true to yourselves, to that niche specialism that you'll have developed your business in. It's easy to look at opportunities at the end of your nose, which might generate short-term cash, but probably devalue the business overall because you've lost your focus. So I think stay focused would be number 3. And number 4 is tight financial management. And one of the areas that people often lose value in a deal is around the balance sheet, and it's around cash, and it's around working capital, and it's around invoice discounting, and managing those things tightly to make sure you can maximize the cash you take out of the business, is another big piece. And I guess the final one would be, this is a question you always ask me, Gary, and there's no right or wrong answer, is what's the optimal mix of temporary and permanent in your profit and your revenue? The current market we're in general, the perm world has got a bit harder, and in general, the temp and flexible world has got more interesting again. So making sure that mix, whether it's 50-50 or 60-40 in favour of temps, I think ever more is a more important thing to do in terms of mix of business.
Absolutely, and sadly, one of the key things I absolutely, Gary, like yourself and Dean, have to try and bring to the table is the idea of changing course. You hate the word pivot. I hate similar words. But point is, why do tomorrow what you did yesterday and expect different results? It's just insanity, right? So a lot of what we've been doing is helping businesses anticipate what the next 3 to 4 years will have in store economically. We're then looking at the client base they work with. We're looking at their credit worthiness, the sector in which they sit, what we're likely to see. And of course, does that mean we have to repivot or change course? So those businesses that are going to weather the storm will be those, Gary, who can navigate, what's going to be a continued choppy landscape. Those who sit tight, cross arms and wait for the good times to return, well, we'll either have to be incredibly patient or we'll have to have deep coffers, because I do think it's going to get materially worse before it gets materially better.
Visibility of income and the ability to see what's happening in the future has always driven value. I can point to many businesses where you've got, £5 million of EBIT, which are far less valuable than others with £1 million of EBIT. And that comes around to, and I hate to use a slightly technical word, but it's the quality of the income. It's where it comes from and what it looks like. And I think even more so in this market, people will be looking to ensure, if you've got a big contract base and you've got a whole bunch of people in banks, people will be looking at what the plans are of those customers and with regards to that base. I think it's fair to say, first of all, I'll put cards on the table. We haven't gone into the market with anything that's either perm or temp since lockdown. However, I would be very surprised if the contract model or something didn't still achieve a significant premium on anything in the perm space, for the reason that I've just described with regards to quality of income. You can place someone, where's the longevity of that business, where's that income, there's some forecastability. Size-wise, I think that the same would apply if we're looking across the market at the moment, maybe to some slightly larger deals, as in are people at the moment, and if you look at the buyers of the smaller businesses, the $1 million to $2 million EBIT businesses, which are still lovely sized businesses to have, but they tend to not be acquired by the large corporates. And so I think if you look at what private equity is looking for, who are the big buyers in this market, and not just straight private equity, but private equity platforms that have made some deals and want to build up on those synergies, buy and build type plays, I think they'll come for. So naturally, I think the market will be larger in size. Something that's more fragile with a lower number than you suggested, 500,000, 600, 700, 800 grand of EBIT, I think is going to become more susceptible in the market because people become more concerned that it's closer towards break even. So that's size. Sector-wise, clearly, as ever, and as I've always said, niches pay. And if you are in the niche at the moment and you're placing serviced office staff, you probably are not going to be celebrating or that attractive to a market. However, if you are someone who provides technology services to remote workers and to other markets, or I won't use all the COVID case studies, but you know what I'm talking about, your masks and your technology. And if you're someone who supplies staffing into medical testing facilities, of which there are a number, yes, you'll probably be very, very well placed. So sector-wise, I think people will have refocused on the sectors that are appropriate to look at. Size-wise, I think there will be a trend toward deals. Feature of buyers, private equity features looms large. And what the private equity guys are doing is they're coming in this market with less leverage, because the banks, and one would argue sensibly, are not giving it to them. So they've got to go in less levered. But they realise that unless they do that, they're not going to be competitive in an M&A process and they're going to lose their deals. So, but private equity is a big piece. And the other thing that people will be looking for is they'll be looking for low cost bases. And I think that's really across the board, whether it be for staffing, whether it be for premises, other infrastructure. People won't want to be looking at businesses with huge costs. To have your swanky office in wherever you are across the UK or in London, those longer term commitments, I think buyers and what we're seeing on other deals are more jittery with regards to what could happen if we had another lockdown, if there's another event. Because of course what you need to realise, and I'm sure you do, is pre-lockdown, people are concerned about what happens if such and such, we suffer a decline in 5% here or 10% or disaster, it's 20. People didn't actually contemplate that there could be a shutdown in what's going on in business. And that's what's happened. So a flexibility, a low level of operational gearing, a low level of fixed cost in the business, and a business model that allows you to scale without the requirement to get lots of people on board is going to be a feature of what people are going to be looking for. So for all of your members who are looking to do the right thing and build those, those new businesses, I think it's a great time to be doing that. For all of those that are doing that, it's about having flexibility in cost base. And if someone said, I'm going to get 50 people on board and we can deliver this and we'll employ all of them, wrong model. Is there a way to do it on a contract base? I'm talking about for your specific staff. So there'll be some trends, and I think it will become more apparent as we move forward.
Can I just quickly touch upon MBO'S for a second? So I reckon there might be, all of the CEOs who've worked with the RDLC, we haven't taken a day off. We're absolutely grafted all the way through this. And I think people don't really realise the stresses and strains that come with that. So we're worried about ourselves, our families, our businesses, finance, and then other people and their families, right? This has been a really tough time. I wouldn't be surprised right now that a lot of people just say, this is enough, I've had enough, and then want to sell this to their existing staff. Is there availability for funds for that? Is there an appetite for it? Would you say that's still an attractive proposition for like you to facilitate it, or it's
Well, let me put myself at loggerheads with a number of people in the advisory community, and I say this, and I don't know who will pick up on this video, but I've always been of the view that there's an overly close relationship between those in private equity and those in the corporate advisory market. Because what happens is someone comes in to sell a business and the advisor knows that the quick and easy way to do it is to stick them with one of their mates, whoever it may be. And I won't name names in the private equity community, but you know the guys, and there's plenty of them, to do a deal. And what they do is they say, "Oh yeah, come on board. Don't worry. We'll find you a fund. excuse me, a funder for your MBO, it'll be easy." And of course, what happens is they're enticed to sign up and to engage. And then once they start going through the process, they realise there's no real value from this MBO for them. They could have got more money in other ways, and frankly, by borrowing through the business in many cases. And they've only been encouraged to go into it because of this advisory relationship where the advisor's putting them with their mates in private equity. Do I think at the moment, and of course there will be exceptions, do I think that the MBO market is going to be awash with deals in private equity where they're coming in saying, yeah, we'll do these private... I don't think so, for the reasons that I've described above. I think new models will emerge and things will change and morph, and they certainly won't want to be taking too many risks, I don't think, in the market. However, and it's a big however, if you look at the number of platform deals that private equity has done, so they've bought a business and they're going to use that business to acquire others, which has, in my view, an advantage for the exiting entrepreneur insofar as they don't need to continue working with the business. Do I think those will continue to be a feature of the landscape? Absolutely. So standalone MBOs, can I sell mine to private equity and have to throw half my money back in? But don't worry, I'll have a 25-year-old I've got to report to for the next 5 years. I think they'll be less and less common, certainly in this market. But what we will see is the bigger players in recruitment that are private equity backed, going out and acquiring, either coming back to what we said earlier, the strategic assets that they need to get into, or those that have been brought to their knees by what's gone on, and they can take advantage of a difficult situation at the moment.
It sounds like I'm sitting on the fence, but I would balance the two things. So I would definitely keep some cash in the bank for a rainy day. So I might preserve half of my cash to make sure I've got some rainy day cash, but I'd have a very clear and focused investment strategy on the 2 or 3 areas that I think were most important to me to invest in. And that means different things for different people in different industries, but investing in people, investing in technology, investing in marketing to make sure you're capturing a really cool client base. They're all very valid things to spend money on. I certainly wouldn't go all in, and I wouldn't spend all of my cash on investment. I definitely want to keep a decent chunk, perhaps up to half of it in my back pocket for a rainy day.
one of the things that we talk about quite a lot is the story. It's having a plan, having a vision that you both, and there's a story internally, a story to your clients, and a story to your investor community that they see. So I think Sean Wadsworth absolutely crushed it with the story that he got. Nigel Frank, we owned the dynamics market. We haven't really touched contracts in this, and just think we can take this model, this machine, and do it everywhere else. That was brilliant. Do you do any work? So if someone were to engage with you, and I'm assuming you'd like to get engaged at least 2 or 3 years before any eventual exercise event. How do you work with people to help create that story and that's that energy that is believable, and it's got some truth and substance to it? It's got truth and substance to it. Yeah,
I think creating it and delivering it is really powerful when people look back and do their due diligence. So I think that's spot on. We typically get very engaged in the 6 to 12 months before an exit event and start to get more up to speed with the business and helping people out 2 to 3 years from that point. And there's a process of going through the business planning to make sure you're hitting the end objective. So we would always start and say, Gary, you've got a great business. You're thinking of selling it in 3 years' time. What's your end game? What do you want out of it? What size of business? What's your magic number in terms of value, et cetera, so you can start to get the objectives. And then you start to build a business plan to fit those objectives. And that is about telling a story, and it's which markets you're in and why, where's the growth coming from, why, what does the competitive landscape look like? How do you match up against them in terms of USPs? What about your team? Have you got the right people in your team? Have you got a loyal consultant base, or have you got high churn? What does the culture of a business look like? And all of that flows then into the financials and where you want to invest money and place your chips. I think less than £1 million worth of EBITDA, becomes very challenging for M&A for anybody, be that a trade buyer or be it a private equity fund where you're typically too small. As soon as you start to hit £4 or £5 million worth of EBITDA, it becomes very interesting for mid-market private equity, and it starts to make a difference for most trade buyers. That's where the switch normally takes place.
For a business to really grab the attention of a potential acquirer, it needs to be generating an EBITDA or a pre-tax profit, Gary, of circa £750,000 plus, because arguably until that point, a business will be of a certain size whereby it will definitely still be reliant heavily on its owner founders, and therefore it's difficult for that asset to be sold and for that value to be retained by the ultimate acquirer. So most acquirers in the market would look for a business that's generating a pre-tax profit, Gary, of £750,000 plus.
So, look, the first question, and I always said it's got a conflict of saying this. So, our traditional blue box business, which is very much a hands-on corporate finance offering, we charge somewhere between 30 and 40k to get started. Depending on the business, we do a lot of hand-holding. We ensure that businesses are properly prepared. They've got all of their IP in the right place. You've got a business model that properly reflects the growth. You've created the barriers to entry. Your timing's right. Your management's incentivized. The honest answer to that is you need to get someone on board as early as possible. And of course, my mates all turn around and go, yes, it's to get the punters in. But the reality is you can't start too early with that planning. And I think you said it earlier, Gary, with your experience, it's the first thing after you thought about the brand is how do you get the exit? Well, I can show you plenty of recruitment businesses that have set up, or many businesses for that matter, in a particular market. And you say, it's a shame you've done that. If you would have started in a different way, you'd be in a very different place and far more attractive now. So the rather generic response to that is as early as possible. And we engage with people normally a couple of years, somewhere between 6 months and 2 years before their exit, and assist them with that planning. And that's what a lot of advisors miss. You can't just suddenly turn a business and apologies for the use of the word again, but repivot in that market. So I think as early as possible on that. And just quickly on and thank you for the opportunity on velocity. So in lockdown, I sarcastically say the M&A world is going to be absolutely thriving. And I suspect that's not the case. There'll be more competition. And don't get me wrong, we're well funded and we're continuing to go. And we've got some fabulous clients we're still working with. And BLUEBOX Corporate Finance will continue, we hope, to do well. But what people really wanted in our market, and what we saw and what was driven by COVID, is people want more of a DIY solution, a quicker solution, and an earlier entry point. And I think I said before, it's 35, 40 grand to get going with a corporate advisor. Is there a way to do something for a dip of the toe in the water? And what we've created through Velocity and the website, if I'm allowed to say it, is blueboxvelocity.com. What we've enabled to happen is people can go in, they buy the product online, and we offer 3 services. I want to buy a business, I want to sell a business, and I want to raise funds. And for each of those, you have a classic and a premium package. And what you can do is you buy online. Someone said to me the other day, where do you send an invoice? I said, you don't. It's PayPal or credit card, which I loved saying. They bought it online, and within about an hour and a half, they had completed a document we'd sent them. It's all very much, I'm very OCD-ish, sadly, and it's very much a process. They got some sheets, some checklists back, brought them back to Velocity, to us. We were sent them in, and within 24 hours, we had a list of investors for them and a target prospectus that they were going to use for this exercise. And that was all put together with technology behind the scenes. They paid 1,500 quid. We'd extended a 20% discount, which, by the way, Gary, I'd be delighted to do to your members as well. And what they then did was they approved the list. They thought it was a great list. They approved the document, which had been done automatically. And it's not a big, shiny IM, you can imagine, but it's a 5-page good document. And once they'd approved everything, we spoke to the investors and said, we have a client that's doing X, Y, Z. Would you be interested in talking? And of the 40, 17 people came back. It was a brilliantly researched list, got a huge amount of plaudits for the quality of the list. And they came back and said, who do we speak to? And we said, well, you speak directly to our client. We're out of the picture now. And so our client wasn't tying up with 30, 40,000 quid. They dipped their toe in the water for 1,500 quid. And they then knew, once they were contacted, that they had a dialogue. And they were able to go and speak with their mates to negotiate these deals. They could do it on their own. They could phone up the likes of Gary, who I know is very experienced in this market. They could speak to their accountant, their lawyer. If they wanted us, we still offer monthly support. It's very much non-hand-holding, but it's a quick, cheap, and very effective entry point for people that are looking to either buy, sell, or raise funds. It's going to be hugely disruptive in the market, we believe, because everyone out there in our market, including with BLUEBOX, is looking for those big monthly retainers, and that's what clients hate. So we've used the time to do that, and I'd love the feedback and from any of your guys, and we've got a team now that's more than happy to engage and talk through that, and we think it's very relevant to the market now.
The future is more balls than crystal. Nobody really knows what's going to happen next. But what would your bit of advice be, if they're looking at maximising their value and at some point wanting to run off into a sunset? What might that be?
I think hold your nerve would be my piece of advice, because the world, it's a unprecedented period of time, but it will come back. So I think holding your nerve. Continuing to invest at the right time without putting yourself under cash pressure, in people and in client relationships, making sure you've got that longevity and that trust, both with consultants and with clients. But, hold your nerve on that, and the market will come back.
Thank you very much. Really appreciate you doing this. Hopefully I'll see you soon, sir.
Yeah, catch up soon.
Really, thank you very much on behalf of everybody. Carl Swansbury, everybody. Thank you, buddy.
My pleasure, Gary. Thanks for your time, Gary.
Sir, thank you very much. Have a lovely rest of a break. Enjoy your summer, and I'll see you as soon as I can.
Thanks very much, Gary. Nice to see you.